Hello, welcome to the next video on this series about the different types of taxes. Next, we are talking about capital gains taxes. And so what is a capital gain? So you start with let's say you take your income, it's already been income taxable, which we talked about in our last video, and you put that in the bank, it's $50,000. Now, let's say that has generated interest. And then let's say you grow the money, you throw the money in the stock market. You are actually going to have to pay taxes on the growth of that money, and that's a capital gain that you would have to pay. And so all assets that are outside of a tax shelter are subject to capital gains tax when they grow in value. There are many examples of where there are exceptions, of course, such as selling a primary home. You don't have to pay capital gains tax on up to $250,000 or $500,000, depending on if you're married or not. You can offset gains with losses, and so that's another way to avoid capital gains tax. But generally speaking, if you have an investment outside of a 401k or an IRA, you will be paying capital gains tax on it. Same with selling a business, you'd have to pay the capital gains tax on that. If you sell any type of property that has a gain in the value, that's when you pay the tax. Otherwise, you would have a loss. And I talked about in another video series on taxes and retirement about tax loss harvesting, because the gains can offset the losses, and you can claim up to a $3,000 loss in any given year. And so there's a lot of strategy to consider, and that's a big part of portfolio management, is looking at the taxes within your portfolio and making sure you're aware of that.